to Jim Dalton's presentation, How to Prepare for Morning Trade. It's fabulous to see you all this morning. Thank you for coming out. Jim and I want to thank everyone for the wonderful warm reception we've had coming back. It feels really good to be back and reconnect with our clients and new traders. So thank you everyone for the warm welcome. It's wonderful to be here, and we have a lot keyed up for today, so I don't want to talk on here. I want to hand it over to Jim, but just so you are aware, this webinar is being recorded and will be uploaded to jdaltontrading.com, and our friends in Houston are uploading the PDF of the slides as we speak, so I will send you a chat out there once it's at the website, and I will hand it over in handouts in this, GoToWebinar interface. Sometimes the handouts don't work for some people, so you may have to go to jdaltontrading.com webinars, upcoming webinars, to grab those slides. Okay, so with that, fabulous to have you all here. Thank you for being here, and I'd like to introduce the Market Profile Master, Jim Dalton. Good morning, Jim.
Good morning. Thank you, Julia. Well, we're ready for this morning. We're, instead of doing a hypothetical or theoretical presentation, we're using the live markets for this presentation this morning. Start off, and everything that I start with centers around the brain. And this is a book I recommend to everyone. This was a companion piece to the PBS series on the brain. It is a wonderful, wonderful understanding. The brain consumes about, this says 20% of the calories we take in. In the past, when I've worked with some fitness experts, I've used the figure 28%. But what's really important is the brain is it's energy conserving. It processes only the minimum amount of information that the senses think they need to navigate the world. And this is a great concept. Think about the first time you backed a car out of the garage. You went through step by step. You got the key. You put the key in the car. You backed the car out of the garage. You turned your head around. You made sure you were looking. It was quite a process. After you've done this a few times, and today if you've been driving for any period of time, you do it in almost an effortless manner. And again, if you looked at patterns of the brain, MRIs of the brain or fMRIs as it's going, it would show very little activity today when you have got this down to such a routine. Those routines are what allow us to get through the day. If we didn't have these routines, it's called chunking and using the brain. If we didn't have those routines, it would be very difficult to get through our everyday thing, just to go to the cupboard and get a glass of water. However, looking at something is this idea that the brain is lazy or it's energy consuming means that looking at something is no guarantee of seeing it. If you doubt this, watch the Magic Act we have at our website under resources. It's a magician and sleight of hand. You don't see everything that goes on. And that's one of the problems that we have in preparing for trading or looking at any trade. Our eyes and our mind don't take in all the information we should be taking in. I'm going to try and cover what we should be looking at today. Our preparation for today, it's a two-part process, looking backwards and then looking forwards to uncover the information that our energy-wise brain might have missed. Traders who enter the trading day with a written plan, review, and trading plan are likely to be that don't enter the day with a written plan are likely to be at a tremendous disadvantage, because sometimes you can't make all the decisions we have to make on the fly. And so it's very important that we prepare ourselves to act quickly if the need be. Okay, let's start with the current market and looking backwards on a top-down basis. I always start top-down when I'm preparing for the day to get the bigger picture. Once I get the bigger picture, then you'll see at the end, then I fit the current trading session and look at more specific things we might be looking today. I start with the monthly bar. So if you see that looking at the monthly bar, the last 3 months have one time framed higher. We had an outside month, and then we have one time framed higher. One time framing simply means that the low of this month did not take out the low of this month. Very strong market. You're trading under this type of scenario should be to be looking to buy breaks. So that's what it looks like from the monthly bar. I then go to the weekly, and I look at the weekly, and I see a similar pattern. I see an outside week, and then the market continues to one time frame higher, and you see we had a new high just recently. From the weekly bar, I then go to the daily bar, and when I get to the daily bar, I'm starting to narrow my world. As I bring it even tighter, we'll go next to the profiles. But what do I see when I look at the daily bar? I know the monthly were one time framing higher, the weekly were one time framing higher, so all modes of the market are straight up with recent new highs. Currently, we have 3 gaps in the market. And for those of you who are not familiar with us, we only measure a gap from the previous day's low to the previous day's high, or from the previous day's range. We're only looking. So in this case, we have a gap because this market opened higher. This gap was never filled on a daily basis. This gap was never filled. This gap was never filled. 3-day balance, and on top of that, we have a 3-day balance with 2 back-to-back inside days. That is about the ultimate case of balance you can get. So as I look at this morning, I'm saying I have a balanced market. I have very little excess at the all-time highs. And what we're going to do today is apply the balanced trading rules. The balanced trading rules are look above balance and fail. One, stay within balance. If you stay within balance, you have pretty much of a rotational situation. Look above or below balance and fail. Look above or below balance and extend directionally. Okay, so right now we have a 3-day balance coming into the morning session. What I'm looking now is at the profiles that is inclusive of Friday, exclusive of what has happened in electronic trade since Friday. We had a late spike up on Friday as the market was getting squeezed in the final expiration. The final end of week options expiration, and that can sometimes do some funny things to a market. This spike, the base of that spike is 2343.50. So now we have an additional rule, and that is the spike trading rule. So the spike trading rule is that the question is, did prices go high enough to cut off the buying or not? The base of the spike is support. If we come down, so that's support. If we open below the spike, tells us the spike was rejected, that would be bearish. If we open above the spike, it tells us that prices had not gone high enough to cut off the buying. Then, of course, if we go above that, the next reference we're looking at is the 2351. Now, before we go any further, we've talked in pretty large generalities so far. I'm going to go back to my own screen, and I want to show you something that I'm guessing most people don't know what to look at. This was 2:15 or Wednesday when the all-time high was made. If you will look at Thursday's early morning high, Thursday's early morning high was a single tick below unchanged from Wednesday the 15th. The rally high, the C period rally high on Thursday was one tick above the opening. When I see that information, that my mind is trained that tells me a lot. One of the things that we're always trying to ascertain in a marketplace is, are we looking at simply trading money, or are we seeing evidence of new longer-term buying or selling coming into the market? When the market goes up on Thursday to a single tick below unchanged from Wednesday, that immediately alerts me to the fact that I had trading money up there, not new serious money selling. New serious money selling is not going to simply wait till we're one tick below unchanged from the previous day. This is an indication of short-term day time frame and short-term trading money. The rally high to a single tick below the opening is another indication that I have short-term traders in this market. That is those are significant pieces of information. Everything that we do is probabilistically based. The human mind is not prepared to think in terms of odds. It's just not something we do very well. We have to train ourselves to do that. When I take in this information and I'm saying, to me, it's very unlikely that this all-time high is going to last. More than likely, this is going to get some trading money, and then these can, or in my opinion, likely to be tested again. So if you look at Friday's rally came up and did take out the C period high from Thursday. However, it did not take out the high from Thursday. And again, remember I said this was a questionable high to begin with. We classify something like this as a weak high. A poor high would be, this is a poor high, no excess, no single print selling tail. This is a weak high because it went one tick short of a mechanical reference. That is a kind of information that helps me think in terms of odds and helps me understand what I might want to do from a trading standpoint. So if you look at Friday's low, we had, this is also important, when you're learning how to look at a market, you're trying to learn how to back out of the garage in as effortless a manner as possible. We had 3 distributions on Wednesday. 1, 2, 3. 3 distributions is usually an indication of a market that got emotionally overdone. We came back on Thursday, we took out 2 of those distributions. This lower distribution, everybody's always looking for references. This lower distribution is a short-term reference. Think of each of these distributions as a separate day or auction. So we took out 2, but we didn't get this one. And you see that that single print between these 2 auctions served as the low on Thursday. The overnight low on Thursday went one single tick below this low, and you can see Friday's low did not take this up. This was our support level on Friday, at our short-term support level. It is also a reference that we say we carry forward. So now the market rallied Friday. The next thing we're going to do is we're looking at, and I know we have slides for this, but right now we'll come back to this in just a second. We've got about 15 minutes till the market opens. So let's go back to the slides. Okay, so what we've reviewed before we go and look at the overnight trade, we're looking at what the market looked like at Friday's close. At Friday's close, we had a 3-day balance, with the high of that 3-day balance being the all-time high at the 2351 level, and we have support at the 2336.75 level. That's our, we're using this as our balance area. Theoretically, the 3-day low is right here at 2332. I'm using this one actually first. If we get through here, then we target this low. But this is my shorter term reference. Okay, going forward again, scenarios and action plan. The biggest trades occur at the top or bottom of the 3-day balance. In other words, either you break out of the balance and go. The smallest trades are going to be if you stay within balance. The biggest trades are any time when you're outside of balance. So outside of balance, either on the high or the low, will be the major reference for today. You can see the rules. I've talked about these. They're staying within balances are more limited type of trades and opportunities. We talked about Friday's spike. We have spike trading rules. They're probably not going to be applicable this morning because, well, they are, because we're well above that spike. We're well above that spike. We have a gap. Remember, we said trading below the spike is support, or the bottom of the spike is support. Okay. Here's where I want to go to. So now we've talked about the 3 days ending Friday. Now, overnight trade on Monday, electronic trade during the day yesterday, and overnight trade last night. Okay, when I took this slide to put up for this morning, we were trading right where the yellow line is. I'm going to leave this slide and I'm going to go to the actual market here very shortly. But we've got about 15 minutes till the market opens. It looks like we're going to have a gap opening. So the rule we have, just as we had spike trading rules, now we have gap trading rules. The gap trading rules are more than likely in effect this morning unless something really drastic happens in the next few minutes. The basic rule is go with all gaps that aren't filled fairly quickly. And I can't tell you what fairly quickly is. I look at the market, I'm looking to see, does it appear to me that there are sellers there and that those sellers can get down into and fill the gap from Friday. That's not going to be my first reference today. My first reference is going to be the all-time high. In other words, in order to get down and fill the gap, the first thing I'm going to have to do is get down below the all-time high. We have at least last time I looked, the all-time high was made in the overnight market on Sunday night. For those of you who have been with me for some years, I continually say, at least in the S&Ps, it is extremely rare that I will ever see a long-term auction high or low established in the overnight or electronic market. We've had them last for some period of time, but I've never had one in some period of time that I have seen last. Even when the market had the big break many years ago in following the Lehman Brothers bankruptcy, big down overnight, but the day time frame did go down and tag that low to the tick. So for all practical purposes, the odds are that this high will be taken out before the current auction is over. Okay, so the gap rules. Go with all gaps that aren't filled very quickly. If the gap is filled, then you want to see if there's acceptance back within Friday's range. And if, as the market is trading lower, if value doesn't build to at least overlapping, this is the value area. For those that aren't familiar, value is approximately 67% or 2/3 of a daily trade took place. It's the filter we use to have a pretty good idea of what's really going on in the market. So if the gap is filled and value doesn't build to at least unchanged, the odds of a late day rally, or a later day rally are high. All right, I'm going to come out of the slides. I'm going to go to the current markets. And you can see we have 10 minutes until we open. We're at this is the current high from last night. This is the high from Sunday night. The settle, I'm marking right here, the settle on Friday. All trade, with just a few exceptions, just a little bit of time, almost all trade from Friday took place above Friday's settle. That tells us that overnight inventory is almost 100% long. As we have tracked this over the years, we have found that there's a very high percentage, someplace in the 65% range, that overnight inventory will be corrected. So what are we dealing with this morning? We have overnight inventory is long, or we have another one. If overnight inventory is long and the market doesn't care, that's a very bullish indicator. The odds are that the market will correct that overnight inventory. Those odds are about 65%. If the market doesn't correct overnight inventory, that's a very strong indication that, at least for right now, the market is strong. We're going to gap higher. We have the gap trading rules, which we've talked about. We also have this morning the overnight high. The overnight high is a very logical, visual reference. Markets are very visual in nature. Okay, so right now we've got a few minutes for questions, but just to recap, the gap trading rules are in effect for this morning. The gap rules review are once again, go with all gaps that aren't filled very quickly. If the gap is filled, you want to see if there's acceptance back within Friday's range. If there's acceptance back within Friday's range, you want to see if value can build to at least unchanged. All right, Julia, we've got about 8 minutes till the market opens. We'll play this out live this morning. I've got time to take some questions.
All right, great. Thank you, Jim. Is this day trader information only good for that day's trading? In other words, can you carry it forward?
If it's, well, let's say, for example, that the overnight high is not taken out, then I would carry it forward. The overnight high is taken out, then I don't carry that forward anymore. The information down here, the reference at the 2336.75 level, I will carry that forward until it's taken out. The very prominent point of control at the 2341.50 level, I will carry that forward. I will carry the base of the spike forward. So, you know, I don't know if there's a nice, clear start and stop to a lot of this information. The previous all-time high at 2351 will be a reference I will continue to follow unless we get down below it. Okay, other questions?
What do you mean correct overnight inventory?
Okay, overnight, how would you, if overnight inventory is long, the correction to overnight inventory would be selling. If something is long, if the inventory is long, you sell it, that brings your inventory back. It corrects your inventory, it brings the inventory into balance. Right now, overnight inventory balance is to the long side. And the reason we focus on that, and the reason that overnight inventory is so often corrected, is that the trading done in the overnight markets is very often done by weaker hands traders. The larger firms, or the larger money, has a tendency not to trade overnight because the markets are too thin and they get annihilated if they try and do any buy or selling overnight. They get annihilated and people front run their orders So the bigger money, unless there's really something important going on, so much of the overnight trade is done by weaker hands. Now that's not 100%, but it's a general rule that we have found very common over time. One of the most difficult situations a short-term trader has to deal with is when the market, say for example, the market is long and the market sells off early this morning, correcting overnight inventory. And once that overnight inventory is corrected, the market then rallies. That is the one that throws traders for the loop. They see price going down, they see the correction, they think the market's going lower, they think the market's weak. In fact, it's not. It's just simply a correction of inventory. That's the most misleading trade I think I see in the marketplace. One of the things here is the market, the current market we are in is clearly a momentum-focused market. By momentum focused, I mean it's price-based momentum. It's also, in my opinion, pretty much in the hands of shorter-term traders. And I say that based upon, look at these references, visual references going to within a tick of other identifiable visual references. That is not how I see longer-term money trade. Also, remember, we have 3 existing gaps coming into this morning. If today's gap holds, that would be 4 gaps. The odds of that they're beyond anything that I've seen for some period of time. When do things like this occur? When they do occur, they occur because maybe a market is too short or because there is forcing action. There is rumors out there, and I don't know if they're true or not. I know Zero Hedge had them. I've heard others talk about it, that there's some big hedge fund that's caught massively short, that they had been, on the short side, and particularly maybe a lot of short option premium, and they're caught. And that can happen, and that may be the cause of this. I don't know. We never know these things for sure till after the fact. All I know is right now we have a gap this morning. This would be the 4th gap. It is something I don't think I've ever seen in the S&Ps. Overnight inventory is long. The all-time high was made in the overnight market. Very unlikely that the lasting high for the current market is made in the overnight market. Additional questions?
Yes, thank you. This is an email that came in. Making the preparation from top-down perspective, how does Jim choose the important reference level in case there are more? I mean, how does he decide which one to choose?
Okay, you try and prioritize the references, and there is no formula for it. So much of what happens in the marketplace is by being in touch with the marketplace. For example, if I'm looking at today's references, on the upside, the only reference I really have is the all-time high made in the overnight market. On the downside, my first reference is going to be, hold on, that's just my machine changing over as it gets ready to
Yep, we have 45 seconds.
Okay, so you're going to take the references one at a time. The overnight, the all-time high, going to be a serious reference. Next, you're going to be dealing with Thursday's high, and then Friday's high, then the base. You come at these references just based upon being involved in the market and understanding what's going on. It's living with the market. Okay, we're going to open shortly, and what I'm going to do is just kind of try and walk you through the market as we open. So we know inventory is long. Okay, the market is open. The most logical first upside reference is is last night's overnight high.
You want to shut your time templates, Jim? Just that arrow in the upper left corner. Thanks. Thank you.
Okay, so you see right now we're within the overnight range.
Can you pull down your screen just a little so they can see that overnight high? Yep, thank you.
So what we're looking for when the market opens, we're looking to see if there's any signs of real confidence in the marketplace. We've been open, a little bit. We're in a 5-tick range. Remember, all indicators are up. Almost all short-term traders have been trying to trade the market to the long side. So the logical thing is to go after the overnight high. Now you have one other thing going on in a morning like this. Friday was weekly expiration. With the market up so high, there's a lot of the option traders that may have got exercised, and early this morning, the first hour or so this morning, may have to deal with assignments that some of those option traders got over the weekend. They could have been caught with the market up this high. Okay, so the gap is holding. The logical, which is said, the logical first target is the overnight high. He's talking about a short, that's a short, say target, that's a short-term reference. It's very visible. Okay, questions? We're just watching this market. We're just watching through overnight inventory. All auctions are up. Overnight inventory is long. A new all-time high was made in the electronic market. There was no sign of selling over the weekend. Inventory is very long, which makes it very dangerous. So the first 1 tick short of the overnight high. Another reference they'll use if we start to get any selling, the white line right here is half back. Okay, we've tagged the overnight high. Remember I said markets are very visual in the areas that they go to.
You want to mark that overnight high, Jim?
Well, I was trying not to because I didn't want to get too many lines.
Nope, that's okay then.
I didn't want to get too many lines. It gets too confusing. There's the overnight high right now. So we went to the overnight high. Okay, now the big selling opportunity today would be to look above the all-time electronic high made on Sunday night and then find sellers. That doesn't mean it would really sell off from there, but I'm saying if that happened and we cleared up that high and then began to sell off, that would get my attention. Okay, so right now we said the first logical reference in the upside is the overnight high. The next logical reference is the all-time high. Okay, I can answer some questions as we're looking at this.
Since you can't trade the stocks in the S&P overnight, and since so much of the E-Mini S&P trading is done in concert to the cash market during the day, isn't a lot of overnight E-Mini S&P trading due to arbitrage with other global indexes or indices?
I don't know that, and there are ways for people to trade some stocks overnight. I don't do it. I don't know exactly how it's done, but I mean, you'll see, if you see the tickers in the morning, you'll see they'll have the Dow and they'll have what's that's up and down. So there is some trading going on. Okay. So now we're above the last night's high. It's now going for the all-time high. She said a very logical reference point.
You talk often, Jim, about how the market gets there. It's not just a matter of did it hit the reference, it's how did it get there. Today, the question is, it's very lumbering or slow coming up to that reference. Are you cranking that in, and how would you be using that observation?
Yeah, it's not high confidence. We didn't open and drive right out of the box.
Mm-hmm.
The market, we said overnight inventory was long, so I know I'm dealing with that. We opened and it went up immediately, went to the very visual reference. Remember, all trading references point upward. So the logical thing is that short-term traders are going to continue to do what works until it doesn't work anymore. So now you can see it ground to the all-time high, or to the overnight high, a little sell-off. Now it's back again. So they were buying it again right about the overnight high, still going for the Sunday night high. But you're right. The first thing we know, at least at this point, there is no long-term money. Use this opportunity to come in and be an aggressive seller in the market. They could have sold this market this morning at higher highs than they've seen for a long time, that they've ever seen. They weren't there. So we know that at this point in time that there was no serious money waiting to sell the marketplace.
What does Jim... Oh, pardon me.
Here's where sometimes traders get themselves in trouble. Oh boy, I'm going to fade this market. I'm going to fade this market. Very often you are better with a market like this rather than selling this market. You're better to be late. You're better to be late, particularly when you're going against all directional trade is to the upside. You are generally better off to be a little late in the trade and make sure that you've got some selling than trying to fade this market. Okay, I'm sorry, you were going to ask me a question.
So if it gets back into the balance area, is it considered corrected? He's asking, how do you know when the overnight inventory is corrected? At what level do you consider the overnight inventory corrected?
Well, you'll see it. It'll start trading down below. Normally what happens, it trades below the overnight low, and then you'll see a flush down. It's something you learn via experience. First of all, somebody points out what you need to look at and to think about. And then you start to build your own informational base from there about how reliable it is and what is the other context surrounding it. For instance, the other context surrounding this morning is that all signals are up. A new overnight high, a new all-time high was made in the overnight market. That's what the market's shooting for right now. Remember, I said markets are very, very visual. If you took this out and all of a sudden you start to get some aggressive selling, now you may be dealing with a different situation. But right now, as of right now, there is no selling. There has been no reason to fade this market. Fade means go against. And now we're one tick short of the all-time high. So we've tagged the all-time high made in the overnight market. So that objective, those very visual short-term traders' objectives have been met. Just see, but understand this, how visual markets are. Going back to the question about, a lot of questions about, exactly where do I get in, where do I get out, how do I know when the overnight inventory is corrected? There's a great example in the book on the brain I was talking about. And in that book, they're talking about these extreme rock climb. One example is an extreme rock climber. And with these extreme rock climbers, I mean, you see them hanging from nowhere. They don't do abstract thinking as they're climbing. They're making that climb based upon experience. And one of the things they said, if they had to stop and do abstract thinking, they would probably fall and die. So it's that preparation, it's that accumulated experience that we're talking about. And that's where, first you have to know what to look at. Once you know what to look at, what crevice to grab, what place to put your foot, once you know what to look at, you just start to build more experience around that. Okay, so we looked at the overnight high. They got the stops that were right above it. Now they've traded back into it. As soon as they traded back in, there were buyers immediately right about the all-time high again. That's an indication that was just a mechanical reference. Now the question is going to be, we've looked above that reference. If there's anything on the downside, we leave an excess high up here. The next thing we would do, I didn't mark this earlier, but now I'll mark it. The next thing we would do, if there's any selling on the downside, we'd leave this excess up here. We would now start to find acceptance down below last night's high. So right now, we looked above the overnight high. We got stops. And again, this is a nuance. What you saw, it took out the overnight high. You saw it go up a few ticks, and then you saw a fast sell-off. What you're seeing in there, professional traders will bid the market up in order to get the stops at the overnight high. Once they trigger those stops, that runs the market up a few ticks, and they sell into it. And so you see the market go up, you see it take those stops, and you see it come down, and a lot of times people get faked out by that first little move down. They think it's real. And all it was traders that were bidding the market in order to get the stops at the electronic high. Once it goes 2 or 3 ticks above that stop, they sell into it. Then you see that little dip to the downside. And then you see that there was no carry through to it, at least not yet. So, but that little dip to the downside can trap a lot of people. They say, oh boy, they're going to sell it. And they rush in to sell it, and they get themselves trapped. It still may be a high. I mean, it may be, but I'm saying that's a trap. When I'm talking about this climber, you're talking about how do you accumulate this experience. You accumulate it by being able to observe the market, but you need someone to walk you through what to look at. What should you be thinking about? Remember, so many short-term traders have a terribly difficult time being productive in trading because when you start to trade, there are no practice fields. It's not like I learned tennis and I can have a junior ladder and I can play people of my own caliber. When you trade, you have to trade against the world's experts from day one. That's what makes it hard. Experts are very nuanced based. And that's what you have to learn in this market are the nuances, and then put those together. When I showed you the nuance, when you look above this high, and I said, it's not uncommon for you to look above the high, you get a little spurt up, and then you get a little break to the downside. That was a nuance. Traders went for the stops. They got the stops. How do they profit? If you go long to trigger the stops, how do you take your profit? By selling. So you see the first little move up, that's the stops. You see the second little move, that was the traders that got those stops taking their profit, just a few ticks, and then the market goes back to see if anything's real. And a lot of times I tell people, be very careful, you don't get trapped by the first break to the downside. So that's a nuance. We talk about how visual the markets are. That's a nuance. Learning to trade and learning to trade with any depth is very nuance based. So where are we right now? The market continues to make new all-time highs. This is the fourth gap. I haven't seen. I don't think I've ever seen this in the S&Ps. So the market's got itself pretty well extended to the upside. We've had no sign of selling whatsoever this morning. And remember, I said another thing that may be a nuance is that Friday was a weekly expiration. Well, actually, the assignments go out on Saturday, so traders that got caught, that got exercised and ended up with short positions from Friday, may be forced to cover today. So that can be another nuance that plays into this morning's market. Okay, so now we've got a lot of single prints. We have our references. We've taken out the all-time high. Our references on the downside now are, one, the overnight high from Sunday made in the electronic market. Next would be last night's overnight high. Next would be half back from overnight, because short-term traders look at those references. Next would be the low from last night, which, notice again, here was a previous high. Notice that the overnight low in S period was one tick above the high from Friday. Spike high from Friday. Again, that's another indication that of momentum. That's a momentum trader's buying level. Very mechanical, as close to this previous high as possible. Okay, it's just another nuance. Okay, we've got about 10 minutes left. Julia, fire some more questions.
Okay, what does Jim think of this rally that's been happening over the last few months? We are up 10%, and it seems like every day was poor structure. Most structural references have not been repaired.
Okay, that is, when somebody asks that question, I have multiple answers to it. A lot of times when you ask that question, you're carrying a bias that makes it very difficult for you to trade the market on the long side. So that is my first concern when somebody asks that question, is that bias, and it's what I call, and if you saw the letter that we put out, we're going to be talking in the new Master Series that starts here in May. One of the things, another nuance I talked about in there is what I read it someplace, but I love the term, what I call spotlight bias. And sometimes we get these biases. Some may be that they don't like the Federal Reserve, the debt's gotten too high, or anything. They don't like the political environment, and those are biases. But what happens is those biases can affect a short-term trader and keep you from doing the short-term trades. So that's my caution. Now, come back and I'll answer the question differently. Is do I think the structure is very questionable? Yes, I do. Do I think the odds are that we could come back and maybe have a very serious correction someplace down the road? Yes, I do. Does that have anything to do with short-term trading? No, no, no. This is the short-term traders can get very waylaid by carrying biases with them. A bias that just does this in. When you take a look, what is important on a day-by-day basis? Let's take Friday. Friday, the market came down. All auctions are up. Remember, coming into Friday, I said I didn't like the high, Thursday's high right here, a tick below unchanged. The rally high on Thursday was just a tick below the opening. So I'm carrying that information. I said I doubt very seriously if this is a completion, if last week's high was a completion to the current long-term auction. Okay, so now let's take that. Okay, that's a thought or that I have based on market-generated information. Now let's say that I have a bias and I don't like the way the market's going up, and I don't like the structure, and I don't like the volume, and I don't like the advanced point. At the same time, as a trader, I'm saying I seriously doubt if the high is in. Well, guess what? I made that assessment Wednesday night. I made that assessment on the close on Wednesday night that I didn't think that the all-time high was in. So again, what did the market do on? We had an inside day on Thursday. We had an inside day on Friday. Value was overlapping to lower. But I didn't come close to getting back into this lower distribution. I don't think I have a high in. So no matter what I may think longer term in here, my market-generated information told me that the high probably wasn't in. And where has the trading been? The trading has been to the long side. So again, I'm sorry for the long answer to your question, but it's such an important question because there's so many things that do us in as short-term traders, and sometimes it's these biases. Okay, so where are we right now? We have a market that's clearly on the upside. The gap has clearly held. Hold on, I took something away which I shouldn't have taken away because it didn't give me what I wanted. Okay, so as we go through today, we've watched one opening today. We've watched one opening. We've made one analysis of the opening. You saw how I did the preparation. I start top down, monthly bar, weekly bar, daily bar. Then I go to the profiles for more detail. And the profile showed me I had a 3-day balance, two inside days, ultimate balance. The two most important concepts we ever deal with are balance and excess, because coming out of balance, if you are successful coming out of balance, you start a new auction. And that's what you really always want to be able to identify, the start of a new auction. So we just went through one analysis. We had the spike rules from Friday. We opened above the spike. We had the gap trading rules. The gap wasn't even seriously considered about being closed this morning. We had the all-time high made in electronic market. We said it's unlikely that will hold. Sometimes it holds for different times. It didn't. That all-time high now becomes a lower support reference. We also talked about, that's the bigger picture of how we prepared for this morning, but we also then gave you another nuance, and that nuance is when it took this high out, the market went up and then it sold off pretty quickly and said be careful. All that was they got the stops. The people that forced the stops showed into it. They made a few ticks profit, and that was the end of that little game. Then the market turned back to the upside. Okay.
On that note, Jim, can I just ask a question?
Sure.
It's a good segue that what you just said. I'm confused when or if a trade should have been initiated. For example, it took out the overnight high, then the all-time high. Should I have placed an order once it took out the overnight high, or the all-time high, or not yet? That's what's confusing me.
Okay. The short. This is, every trader has a different tolerance for what they want to do. The market showed confidence from the opening. There was never any selling whatsoever. The really agile short-term trader gets on the market right here. And then you say, you get on the trade immediately, and then you monitor for continuation. What does monitoring for continuation be? You get the trade on. Now you need to find acceptance above the overnight high from Sunday or from last night. Then you need to get acceptance above the overnight high from Sunday. So that's how you monitor for continuation. It never looked back once. one of the things so many times that we are looking at this market and we're trying to find an exact place to get in and get out. That usually doesn't happen. Even Friday, when this market broke on Friday on D period, which was just about the time they closed, the market came right down to the reference. And it came down very quickly, and I went, oh man, we going through? And it took me a while to realize, no, we're not. But again, very mechanical, right down to the opening. And you know, I was late getting back on the trade because sometimes you're not exact. But mechanics, some traders would have been very sharp. They'd have bought the trade, they'd have had to stop right down underneath the low someplace. Again, every one of us is going to do it differently in there. There's not an exact answer to your question. No two of us trade the market in the same manner. But for the agile short-term trader, as soon as we open and there's no selling, you want to get on it. Then you want to monitor for continuation. When it gets above the Sunday night or last night's high and can't follow through, it's legitimate to buy it again. Gets above here, can't follow through, you have one little dip to the downside, nothing there, that's another buy for the short-term trader. Those are all legitimate places. And your stops here would have been someplace below half back. Your stop here would have been a few ticks down below the opening. Your stop here would have been a few ticks below the Sunday night high. Okay. Now, as we monitor this morning, so far there is no indication of selling whatsoever in this market. It just doesn't exist.
And if anything, that volume is high. People stepped in above the all-time high there. I mean, gauging the volume at price.
Yeah, there was. You would expect there to be volume around this. This is, you know, it's a very key point. The all-time high. That is a go, no-go level. And we saw the one dip down, and then it's just buyers are there. So there are no sellers. Now, so what are you looking for the rest of the day? Like I say, it's a very difficult market for me. This is the first time I've ever seen 4 gaps. I don't know if I've ever seen 3 gaps hold, and now 4th gap. The market is in a straight up phase. Remember, that's why we did the top down. Everything points up. There was no indication that there was any conclusion to the current market, and there still isn't. Whether it's a forcing action because some hedge fund is caught short, I don't know. I keep seeing that, or whether this is just momentum buying. The way momentum buying works, the momentum traders, they buy new highs, they sell new lows, and they're looking very specific references. Remember, overnight, the S period came down one tick above Friday's high, and the buyers were there. You know, that's kind of the way they work in there. One of the things we're going to be, when we start this mastery series coming up in May, one of the things that I said is that I've always recognized momentum trading, and the way we've always filtered it out is to say, okay, value is my filter for every day. Trend and value are always the 2 most important concepts that we deal with. So if you stay with value and you stay with trend, it doesn't really make any difference. But I hadn't given enough respect to integrating momentum trading with the market-generated information, and it can be very helpful, because where it's most helpful is when there is no longer-term money in the market. Momentum trading tends to dominate, and you will. So somebody said we have some structure that has not been repaired. It's not been repaired mainly because we have momentum trading in commanding the market in there. But we've always said you need completion to any auction, and we haven't had that completion. So there's no real change to what I've taught. There'll be a slight difference in tone and in helping you understand better what is going on in a marketplace. Okay, go
a
ahead,
friend
please.
from Romania is asking, are there too many single prints? Or he said just for old time's sake. So, joking, but serious that, there's a lot of single prints in that first 30-minute period.
Yeah, the single prints are a sign of a very emotional type of buying. It does seem like a lot, but I'd rather, because I don't know what's going on in this market. I don't know. I mean, everything's straight up. There have been no sellers in this market. There are a lot of single prints, but what I'd rather do is take the references one at a time. We have a new all-time high this morning. If there's any selling on the downside, if there are too many single prints, well, then you'd see the market start to sell off and get down below the all-time high. Then you would start to see, getting back into last night's range. So right now, remember, we got a couple things going. It's just a market that is just unbelievably directional to the upside. All references are up. We did have an option expiration on a weekly option expiration on Friday. That can impact the market. With the market up so much, that can catch a lot of these guys on the short side, and they have to buy this morning. And we've seen no selling in the market. One of the things going on, there's been no indication of any long-term selling in the market. That's one of the reasons for starting with the monthly, weekly, and daily. And the mode of trading has been to buy all breaks. And this morning we get a gap, which is an acceleration gap more than anything else. So, I mean, everything remains up. Do I think there's structure weak underneath? Yes, I do. Do I think later on there may be opportunities on the downside? I do, but they're not here yet. And the short-term trader that starts leading, short-term traders that have leaned into the wind have been very, very disappointed over the last few periods. Okay, let me go and as we wind this up, do our little commercial. The Market Profile Mastery Series. Of course, one starts in May, goes May to June.
You might want to put that on slide, Jim, because it's small.
It goes from May to June. Second, I will continue to put out daily letters and chat in the period between June 2nd and July 10th in order to give you the continuity. We'll start about a week. I'll start putting out the market commentaries and information about a week before May 1st in order to get people, a little bit of warm-up period to get into this. What we're really trying to do is, in this mastery series, give you as much mentored, accumulated experience as we possibly can. Remember, short-term traders have a very difficult time very often because they have to go in and they have to trade against people that have made it over the years. Remember, there are no practice courts. So the first thing we have is understanding that the people that have traded for a long period of time understand the nuances, and trading is very nuance based. So that's going to be the first thing. But the second thing, we're going to spend a lot more time working on the self-understanding. And for that, for people that are going to take this course, I highly recommend that you read at least 2 books. The book I showed early on in the slide, the book about the brain, it will give you a wonderful understanding of how we think and how our brain works. And the second is the book Habits, Why We Do What We Do in Everyday Life and Business. And accidentally, this book was recommended to us, as Julia referred to our friend in Romania, and it looks like you're getting some turmoil over there in Romania too, I see. But anyhow, that book was recommended by a client, a very serious trader, and it's a wonderful book. And one of the way these two books go together is, us traders, a lot of times we get some very bad habits, and we never really lose these habits. But what we have to learn to do is to build new habits over these, and it can be done. The brain, as they call it, plasticity. The brain is very capable of handling change if we instruct it correctly to handle the change. So these two books together are really books that you should devour prior to starting the intensive. And if you don't take the intensive, you still ought to devour them to understand habits, understand how we can help ourselves as well as how we can hurt ourselves. But anyhow, what we intend to do is to give you as much first-hand, hands-on, nuanced-based thought about the markets as possible. Before we leave this, let's go back and take one last look. Okay, we have no excess today, meaning we have no single prints at the high. In other words, we have no indication that even at these new high levels, there's no indication that any sellers have entered the market. So as we leave this, all auctions remain up. If there is to be a change, you will see a change in the pattern of the market. You will see, for example, if there was to be a change on Friday, on Thursday we had a high on Wednesday. If there was to be any change, the market would have easily gotten down into that first lower distribution from Wednesday. There was no change. Trading is about change. So you don't want to get excited because you say, here's an easy mechanical reference, but there was no change. The market remains up. Another gap, haven't seen 4 in a row, but the market remains up. If there is to be a change, we will start to see some excess made in the daytime frame markets. We will start to see some volume, and we will start to see re-entry back into some of these prior references.
Jim,
let me say, yes.
A couple of quick questions. The triple distribution you were mentioning earlier, can you show that to this gentleman so he can just understand it?
Wednesday, there's one distribution, there's 2 distributions, there's 3 distributions.
Well, point to it. Yeah, there you go. Okay.
There's 1, there's 2, there's 3. Oh, this is 1, 2, 3.
I mean, the ABC is 1.
Yeah, I treat each, just see where the market you look at it and see this is different, this is thin, this gets fat, this gets thin again. They just kind of spell out at you. And I treat these distributions as separate days or as separate auctions or individual days. Okay?
And one other question. Judy would like to see the 4 gaps again. Could you just show that on your daily bar? Do you have that chart up? That's gold.
Okay. There it is on the daily. There's one right there, 2, 3, and I think Julia made these slides available to you.
Yeah, anyhow, last night there was the 4th gap, which we didn't have when we created the slides, obviously.
Let me say thank you, and let me say we would love to have your participation in the upcoming Mastery Series, and we make the commitment. We've come back, and one of the things I've said in the letter, the information we put out, and it's very, very true. Stepping away, after I retired, and stepping away, going to Thailand, hiking in the U.S. and hiking in other areas, and just doing some fishing and getting away, and my mind wasn't even intentionally focusing on trading. I thought I'd moved entirely away from it, and the truth was things just started to flow back in, and it gave me just the opportunity to step back and kind of review everything we had done and asked myself, are there things that we could have done differently? Are there things that we could have done better? Are there fuller explanations? Are there areas that deserved more importance? And you'll see that we've addressed those. I retired 3 times from UBS Financial Services, and every time I went back, every time they brought me back, I was of more value to them than had I stayed there all the way through. Because every time I left, I did something else that gave me more experience, gave me more time to think about things. Sometimes when you're trapped on a day-to-day basis, it's hard to expand your thinking. Stepping back is a very powerful tool for expanding your growth. And I think that's happened, and I think that will be very evident as we go through the new Mastery Series. Once again, let me thank you very, very much, and Julia, thank you.
All right, great. Thank you, Jim, and thank you everyone for being here and the great questions. Always makes the presentation better. And we will have this recording posted to jdaltontrading.com under recorded webinars in the next 2 hours. Okay, so please come back. We also have 9 other webinars upcoming, so you can go to the upcoming webinars page and check it out. And if you have any specific questions about the upcoming Mastery Series, you're welcome to call us too, okay, because sometimes there's individual concerns or questions, and we're happy to clarify them for you. Just so you are aware, all Mastery Series content is recorded, and we allow you to download all the content so that you can create an archive on your hard drive and go back and study it and review it in months and years to come. So you don't need to be there in real time necessarily. Okay, so thank you all for your attention and coming out, and we'll see you next week, God willing. And Jim, thank you very much, and thank you everyone. Have a great day, night, wherever you're at, and we'll see you next week. Bye-bye.